revenue up 32%, profit up 32%, dividend up to 80 cents, a very nice uplift there. You do caution, though, about future revenue growth. What's changing?
Yeah, I get that question a lot, it seems. Really, what we're saying is that if you look at the business across the board, whether you're talking assets under management, revenue, earnings, for the period, we're at an all-time high. And that, investors should really apply their minds when looking at a business which is at an all-time high as to whether they should just sort of straight line expectations into the future. So it's really about saying to people, don't be naive about your expectations over the next 3 to 5 years. Look at any assets, not specific to ours, but look at these assets in the context of what drives their earnings ability. And obviously in this 6-month period, we have seen some significant volatility with North Africa and Asia and so on. So we're really just saying, don't be naive about your expectations into the future. Evaluate every business with respect to what drives their earnings.
Well, let's look at some of the drivers of those earnings over that period and the period that we're entering into at the moment, because that volatility is continuing. There is still a lot of uncertainty out there. Do you see a changing investment environment for yourself?
I think, obviously the last 2 years have seen a significant recovery of what was, sort of quite a low point for asset prices. We now sit in a slightly less extreme point, so not the same level of extreme undervaluation or overvaluation. Our expectation is that best returns will be achieved in developed market equity markets, and arguably the worst returns will be, going forward over the next sort of 5-year period. The worst returns will be achieved out of the government bond environment, regardless of where you're looking. Because generally, governments across the world are fairly highly indebted with fairly challenging fiscal environments. And at the same time, if you look at developed markets, that same sort of pole has sort of extended to very good businesses operating in those environments, which we think those two don't necessarily go together. So that's our sort of return expectation going forward.
As a long-term investor, and you do mention that in the commentary today, that you do invest for the long term, do you change your strategy then on some of the short-term things we're seeing in the market, some of the short-term noise we're seeing in the markets at the moment?
Generally, what short-term does is it gives a long-term investor an opportunity to evaluate valuation with a long-term perspective. So short-term fluctuations generally present an opportunity to a long-term investor, largely because those short-term fluctuations are generally in response to fairly immediate developments, be it a tsunami or something of that nature. So the reference to long-term really, the fact that we keep talking about long-term, we're really addressing two issues. The one is, the fact that you should evaluate the performance of any fund manager over an extended period of time, 5 years or since inception sort of numbers, and also the fact that in terms of our process, when we look at investment opportunities, what we're doing is saying, well, what will this business or this asset earn, in 5 or more years' time, and then consequently, what is it worth? So it's on the one hand a process comment, on the other hand, an evaluation comment on the part of a client.
And of course, if you look at your performance over the last 5 years, you have won a number of accolades with a number of your funds. Has that led to a lot more customers coming to Coronation Fund Managers, because you've grown assets under management 14% since September, between September and March. How much of that was due to market performance? How much to new inflows, people coming to Coronation because of your strong track record?
So if we look at that growth in assets under management, we're talking of about 27 billion rand, roughly. From 203 to 231, or sorry, 28 billion, and the 14 billion of that, so half of that, was due to the fact that you're calling out, which is clients placing their assets with us, and the remainder would be market performance, and we've seen the Johannesburg Stock Exchange rise by in the order of 11% over the period. So it's sort of 50-50 over the last 6-month period. But certainly net flows, net asset inflow has been very strong.
And it looks like particularly on the retail side.
Yes. So of the 14 billion, roughly 10 billion was retail. and 4 billion would be institutional. So very strong support, which we're very grateful to have at this point.
Do you give a split of performance fees versus management fees? Because I didn't spot one in the results commentary.
Yeah, we don't actually split it out. What we do is we reflect total net fee over the long term. So total net fee for this period was 69 basis points. There is obviously an annualization in there because we're talking about a half-year period, so we're annualizing revenue to give you that estimate. The full year last year was 70 basis points, and the comparable period was 68 basis points. So it's, you know, the last little while has been fairly similar to history, and the long-run average is also 70 basis points. So more or less in line with where we've been over the very long term.
What are you looking at for the second half of the year? Because most analysts you speak to say the market likely to move sideways from here. And I know that it did reach an all-time high back in February, and even at the end of your financial period in March, it was pretty close to its May 2008 highs. What are you seeing for the second half of the year? What should investors be looking for there?
Generally, you know, our expectation is of more muted returns going forward, given relative to what one has seen historically. You know, we don't give sort of percentage return expectations, but I think it's fair to say that the very strong bounce which we've seen sustained over the last 2 years has more or less run its full course. Asset prices generally are sitting fairly high at fairly high levels, and so, you know, expectations are therefore more muted going forward in terms of investment returns.
And you did, of course, mention that you're seeing the best returns probably going forward from developed market equities, the worst returns from government bonds. How would you then be positioning your portfolios? Would you be going underweight in government bonds going forward from here and trying to get exposure to those developed market equities you like?
Yes, I must qualify that when we say what we're really referring to is nominal government bonds. We do like inflation-linked government bonds,
okay,
for obvious sort of related reasons. But we are very much, in terms of asset allocation, preferring developed market equities and being underweight nominal government bonds.